let's talk about asset allocation, which means how are we going to, if we have a portfolio of money that we want to invest, how should we split that up? Primarily between stocks and bonds, was what Graham was talking about in his book. And he said, well, in general, you should have about a 50-50 mix of stocks and bonds. And in the book, he gives some examples of a young doctor that has a good income, a retired lady, and I forgot what the third one was. But they said basically a 50-50 mix would be a good mix to have a safety of principal and adequate return. Bonds are better at safety, stocks are better return. But in general, that'd be a good asset allocation. He said there would be scenarios in which maybe we would change that. He said if the market looked extremely undervalued, we might make a change to say 75% stocks and 25% bonds. He said if the market looked overvalued, we might want to pull back and say 25% stocks and 75% bonds. And well, what would trigger that? To say, hey, right now is the time to really overweight stocks, or right now is the time to underweight stocks. Is the market overvalued? And he looked at a historical, like a 75-year timeline of the history of the market, and he goes, is there a way that would kind of maybe trigger or indicate, hey, the market appears to be overvalued or undervalued or due for a correction or due for a run? And he looked at three things and the relationship between those three, and he said, well, yeah, there is a way that we could kind of not pick bottoms and pick tops, but pick times when it's overvalued and undervalued and take advantage of that. Take advantage of it when it's cheap and protect ourselves when it's expensive. So the three things he looked at were earnings, dividends, and prices. And we look at the relationship between those three things, okay? So the first thing he came up with is what's called the PE ratio, the ratio of price to earnings. And looking back over a long period of time, he found that on average, that PE ratio was about 15. Okay? That's why we use 15 as our multiple. And when it got really cheap, maybe under 12, 10 to 12, if it ever got that cheap, it'd be a great time to really load up on stocks. And if it got kind of expensive, 20 to 22, that range, oops. It'd be a good time to maybe take some profits. That was the first thing he looked at, was the PE ratio. The second thing he looked at was the dividend yield compared to the bond yield. Okay? Historically, stocks pay a dividend and bonds pay a dividend, right? But the stock dividend, when you buy a stock, you're going to buy it for two things. You're going to buy it for the dividend and for appreciation, right? When you buy a bond, that's all you're going to get is dividend, right? So typically bonds pay a higher dividend than stocks. That makes sense, right? Because if I'm issuing stock, I don't really need to offer such a high dividend because I'm offering the potential for appreciation, right? So in general, you're going to see the dividend on stocks be less than the dividend on bonds. But he goes, what if that dividend on stocks is as good as the dividend on bonds? Sometimes that happens. Like right now, interest rates are so low that they're about the same as on a stock than on a bond. That could indicate a time to really load up on stocks because that means they're cheap. Okay? So if the dividend to the yield to the bond yield is at least 70%, that might be a time to buy more stock. Okay. The third thing he looked at was his margin of safety, which was the dividend yield minus the bond yield. Note the earnings yield minus the bond yield. Okay. And what the earnings yield is, it's the price to earnings ratio turned upside down. Because why do we want to turn that upside down? Because this is 15 is price over earnings is 15. But bonds don't quote things in that relationship. They basically quote things in this, E over P, right? If you had a $100,000 bond and it paid a $5,000, it'd be 5 over 10, which would be an interest rate of 5%. You'd call that a 5% bond. Right, on Wall Street, they'd look at that same thing and they'd say 100 over 5, and they'd call it a 20 PE, right? So how can you compare a 20 PE to a 5%? You can't, unless you turn it around, right? So that's what we're going to do. We're going to turn around the PE to make it an interest rate, if you will, compare it to the interest rate on bonds, and see if we could determine something from that. Well, when the earnings yield on those stocks is at least 4% greater than the earnings yield on bonds, that gives us a sufficient margin of safety to say we should really load up on that. When it turns to be a -4, that should signal all kinds of red flags that is like, there's no reason to be buying stocks when you could do so much better on bonds. It's a margin of safety thing, okay? So in general, that's going to tell us where we should be. So once a month, what we do is we look at that, and where are we, if you will, on these spectrums, these three spectrums. You could say this is one spectrum, this is another spectrum, and this is another spectrum, right? Like a number line. Are we fairly valued, undervalued, or overvalued? So let's take a look at that. Let's look at the PE. So what I'm going to do, I'm just going to search S&P 500 PE ratio. And this one here on Wall Street Journal, it has it. So let me look. Here's the PE on the S&P 500, 1546. So it's right about here, right? So would that tell me the market's cheap, expensive, or pretty fairly valued? Pretty fairly valued, okay. So let's look at the dividend yield over the bond yield. Okay, let's go to the dividend yield is right here. Dividend yield on the S&P 500 is 2.09. You see that? 2.09. What about the bond yield? Vanguard has a good one for the bonds. Okay, so I'm going to go to Vanguard, Personal Investors site. I'm going to click Research, and I'm going to go to Stocks, Bonds, and CDs. I'm going to go to Bonds and CDs, Bond Yields, and I want to see them in a table. So I'm going to compare that to the 10-year Treasury, which is a 184. Imagine that. You could buy stocks and get a dividend yield of 2.09, or you could buy a government bond, a 10-year government bond, and get a dividend yield of 1.84. If stocks do absolutely nothing, you'll still make more money. Let alone put a little bit of appreciation over the next 10 years. Why would anyone want to buy a government bond when they could get that same dividend on a stock, right? That's normally not the case. Normally, bonds pay much more than stocks in terms of dividends. Right now, that's an incredible. The government is saying, please put your money to work, is what they're saying, right? Don't stick it away in bonds or CDs or anything. Get that money out there, right? That's what the government's saying. And you really shouldn't bet against the Fed. So, but the one he really wants to look at is the 10-year, that's the 10-year government. Let's look at the 10-year corporate. Corporate bond, 10-year AAA, 297. That's really where we get this from. So this is government. Corporate is at 297. That's corporate. So if we look at the ratio between those two, so I'd take the 2.09 divided by the 2.97. It's 70. We're right at this point here. 0.70. So what's that telling me? Stocks are cheap by that measurement. By normal historical PE valuations, it's fairly valued. But when we look at the interest rate environment that we're in today, it makes it look pretty cheap. Now let's look at the margin of safety, the earnings yield minus the bond yield. So to get the earnings yield, I'm going to turn this 15 upside down. So I'm going to do 1 divided by 15.46 equals 6.47 is my earnings yield today. Which is basically saying that's what you can expect to make in the market. That's what's priced in. And let's compare that to the bond yield of 2, and by subtracting it, minus 2.97 would be 3.5. Okay, so that's about right here. We're not quite to load up on stocks by that measurement. Margin of safety isn't quite there. Not 3.5%, 3.5. Okay.
Excuse me, where did you get those figures again? Just your
the 6.47. The 6.47 is 1 divided by 5.46, 15.46, and 6.47 minus the 2.97 gives me the 3.5.
So you use the corporate in doing the subtraction, but you use the treasury for just doing
I just looked at it. Really, when I did the 70, I did 2.9 over the corporate.
Oh, you did?
Mm-hmm. I just looked at it for fun. Okay, so by this measure, the market's fairly valued. By this measure, the market's cheap. And by this measure, it's somewhere in between. So probably right now, I'd have an allocation. I'd be a little bit more than 50, maybe 60%. I'm not too worried about the valuation of the market at this point. As in, I'm getting in at a high price. I don't feel that way. And we look at that every month to give you, and it's actually a pretty good indicator. It takes a lot of the emotion out of the market, out of investing. You watch the news and it pours all the emotion into investing, right? Oh, it's terrible news. Market's at an all-time high, I should get out. And they say, well, let's take a look at the valuation. And you can look at it dispassionately and say, I'm not too worried about where we are right now. If interest rates started going up, these would rapidly move this way, right? And that would be a time to maybe pull back. But interest rates are so low, what they say, they're not going to raise them to 14. So I'm okay with the level of the market in general. It's a really good indicator. I mean, in 08, before things started happening, it was kind of flashing overvalued. In 09, when everyone was scared and pulling out, it was flashing buy. Very dispassionate way to look at how we should look at our overall allocation. Okay? So, enough theory.